This is regulatory perspectives on promoting sustainable finance in Europe. And I would like to call my three panelists. So Marcel Haag from the European Commission is the Director for Horizontal Policies, which includes the unit on sustainable finance, together with, of course, Patrick Amit, that is the Director of the Directorate for Generalized Specialized Institutions and LSIs at the European Central Bank, and Burçak, İnel, the Director for Financing Growth at the European Banking Federation. So please, Marcel, Patrick, and Burçak. Yeah. Please go ahead. So, yeah, Burçak, yeah. No, in this side, yes, like this. Okay, so as a matter of introduction, I think we have heard throughout the day a lot about regulation, both in the introduction by Eric, the remarks from the minister, as well as the chair panel, and now with Tony and Laura. We have seen that regulation appears as one of the key aspects that banks, especially in Europe, are really looking into when discussing what is next. We have seen that voluntary commitments and the approaches that we have at UNEP are critical in order to raise the ambition and to push forward the way in terms of sustainable finance. But there's more to it. I think we have heard that corporates, of course, and their plans and their approaches and their investments are needed in order to reach the goals. It's not something that just by looking into the financial industry can be solved. So this is a broader whole of economy, whole of government approach that needs to be followed. And I think that what we have seen with regulation is a clear reflection of this path. So in Europe, we have seen that since the release of the Action Plan on Sustainable Finance in 2018, as well as the updates that came forward, has established a critical framework on how to regulate this approach. And now it's also going forward in terms of corporates and other issues. So what we have here prepared for this panel is to look into how those regulatory perspectives can really foster the approaches on sustainable finance in Europe. And without further ado, I would like already to turn to Marcel to discuss a bit, if you could give us a bit of an overview of the approaches that the Commission and the EU has taken in order to promote sustainable finance regulation, and what are the next approaches?
Yeah. Thank you very much, Daniel. And let me start by thanking UNEP FI for the really close and very good cooperation with the European Commission, and you personally, and also Elodie for all the work that you are doing in the Sustainable Finance Platform, which does a lot of the heavy lifting that backs up our EU Sustainable Finance Framework. Now, you know that the Commission in this mandate has made the European Green Deal its top priority, and has put forward comprehensive policies in a number of areas. So this is really a 360-degree effort, and the EU Sustainable Finance Framework that we are establishing has to be seen in this context and is part of this wider effort. This is also based on the acknowledgement that a sustainable finance framework, sustainable finance can make an important contribution, but is not the silver bullet that can do the trick and can ensure the green transition all by itself. Now, in the last 5 years, the EU has put forward a raft of regulations and provisions based on 3 pillars. The first is the EU taxonomy, which provides a grammar that allows us to talk about what is green and what is not. And ultimately allows us to compare apples to apples, which is indispensable for the development of a sustainable finance framework. We then also put in place a comprehensive disclosures framework that provides the information, the crucial information that investors need to be able to take informed informed decisions in the field. And then there are a number of instruments that are also aiming at facilitating investment decisions, such as the Green Bond Standard and a number of benchmarks. So that is where we are, and maybe where we are now, and maybe I can describe the challenges ahead of us by going a bit into a package that the Commission has put forward a couple of weeks ago before the summer break, where we have first of all completed the taxonomy with regard to all the 6 climate and environmental objectives that the taxonomy aims to cover. We also provided guidance on transition finance, which is one of the big challenges. We heard that the transition is not a binary one where you push a button and you can switch brown from green. Most companies, most sectors have to transition towards green, and it's a journey rather than a one-off, one-step thing to do. So we provide guidance on this based on the elements that we have put forward in our framework. We also made a proposal on ESG ratings. ESG ratings can play a very important role in guiding sustainable finance. So we think it is crucial that we increase the trust in ESG ratings, that we provide transparency, and also make sure that ESG ratings come under a proper governance that avoids conflicts of interests, etc. And then finally, we've been looking into usability, and usability is really what we want to prioritize now. We want to make sure that the elements that we put in place are actually working and are used and can be used by those who wish to engage in sustainable finance.
Thank you. Thank you very much. I think that's a very good overview, and also showcases that while, of course, the regulatory approaches are critical, there are some elements within that are also needed from the financial institutions to show the leadership in the way forward. And I think one thing that we have heard quite a lot today, I mean, given that not only here we're talking to European institutions or to Spanish institutions, but also to global institutions. And UNEP FI is, of course, a global initiative. Well, we're representing here, let's say, the European membership and approaches. How do you see the interoperability playing a role in the work? I mean, we have seen that this Brussels effect has been quite in place in terms of how other jurisdictions are looking into this, but as well we have heard, like Anna Botín talking about the transition plans, the necessity to have this at national level or beyond. So how would you see the interoperability playing a role in all of this?
Well, very clearly, climate change and our environmental challenges are global challenges, and also capital markets are global. So the Commission has, from the outset, thought about sustainable finance as not as a domestic issue only, but as an international issue, and here interoperability and regulatory convergence is absolutely key. Now, this of course depends on having international interlocutors and partners internationally that are willing to work with us on interoperability and regulatory convergence over time. The Commission has, from the start, engaged in the various international fora to ensure interoperability, and we have engaged in the international conversation on sustainable finance. We've been a driving force behind the international platform on sustainable finance, which brings together all jurisdictions that are keen to have that conversation. And we also fully support the work of the G20 on interoperability, and we've made through the IPSF, the International Platform on Sustainable Finance, a number of important contributions, be it on transition principles or also on the comparison of taxonomies internationally, notably the comparison of the EU taxonomy with the Chinese taxonomy. We've also been very active to ensure the interoperability between the ISSB work and the EFRAG work on disclosures and reporting standards.
No, thank you. And I think we're going to have as well tomorrow a discussion between ISSB and EFRAG that is going to reflect on this, and also happy to say that we're quite engaged in this work. But maybe I wanted just to ask a very final question and then ask for Burçak's reaction before to move to say that, well, what would you see the role of the financial industry and the sector in terms of really moving forward and supporting all of this? What is needed to do more, and what is working well already?
Right. Of course, for policymakers and regulators, it's maybe inappropriate to tell the industry what it's supposed to do. Our role is to do, to set the goalposts, the signposts, to draw red lines, and then it's for the industry to do what the industry is supposed to do and is much better at than policymakers. But that said, our expectation would be that now that we have put in place a number of instruments in the financial sector with the sustainable finance framework, but also more broadly with other policy instruments, that the industry, the real economy and the financial industry are using the opportunities that are provided by these policies, by our energy policy, by our mobility policy, by the sustainable finance framework, assess and use these opportunities, and also to provide feedback to us on what works and what doesn't work. We're treading new ground here, also in the area of sustainable finance. So we need to hear from those who are applying the rules and are trying to develop sustainable finance markets. We need to hear from them what works, what is missing, what doesn't work, to be able to adjust and improve and provide the best possible framework for financing the green transition. One important element where we expect the real economy to do their homework in the next future is data. That will be an absolutely crucial element. We cannot do without the data, and here, of course, policymakers' possibilities are very limited. But I stop here.
Burçak, if you want to react briefly on the industry perspectives. Yeah.
And may I cover all my points, or
no, just very briefly react.
Okay, just very
yes,
briefly.
Yes,
I would. So, good morning. I will come back to my points later. I agree with what Marcel has said. Now is the moment to implement the sustainable finance framework, as well as all the other parts of the broader EU agenda. So we will be focusing on the usability of the taxonomy, for instance. We're extremely grateful to be associated with the platform as well, and will be providing feedback. And on the implementation of all the other pieces as well. There are a lot of things where I think the inconsistencies, the unintentional inconsistencies really, because we were doing so much unprecedented stuff across so many different parts, have already been taken into account. Many of them have been streamlined, but all the remaining things were the coverage of one rule with the other, or the timing of things may still not work optimally. I think we will have the opportunity to work on in the next legislative cycle.
Thank you. That makes a lot of sense. And I would like to turn to Patrick, just to also say, complementing as well the views that we have had from the Commission, from a supervisory perspective as well. What are the key elements in the mandate and the approach that the ECB takes to ESG risks, and how it connects with the broader European actions? I think that would be very helpful for everyone.
Yeah, many thanks. As you know, the mandate of the supervisor is really geared at ensuring the safety and soundness in financial institutions and financial stability. So we have, by definition, a rather narrow mandate from that perspective. We believe very early, I think, in starting this journey for us in 2018, 2019, that although we were seeing a couple of banks that were probably early adopters or early movers in that direction, that the rest of the industry overall was probably not starting as fast as we would have liked them to start. And we saw that it was in our mandate, and we took great care of making sure of this, that we would need to issue a number of expectations with respect to climate and environmental risk management expectations. I take the opportunity to add that from the start, we decided to focus on climate and environmental risk. And for us, they do cover nature-related topics as well. I think it's important, to relate to the previous panel discussion. And we really wanted to issue a set of expectations towards the setting of business strategies, risk appetites, frameworks around climate-related risks and climate-related and environmental risks, around risk management practices and governance frameworks in banks. And knowing that, of course, we would sort of anticipate a little bit on the wave of regulatory developments that were to come from Brussels, and that I think Marcel elaborated on those. And so really to make sure that banks do start incorporating climate-related topics into their risk management framework overall as part of our traditional risk drivers. So we decided early on that we would not make climate as a kind of separate risk driver next to credit risk, market risk, op risk, and so on, but as a driver of these traditional risk factors. We believe this is conceptually the right way to approach it. But of course, really wanting to make sure that we would see progress all around. We of course fully welcome in that context the incorporation of ESG topics into the banking package. I mean, this is fully in line with what we believe banks should be looking at. These different risks will have major impact on client situations and behaviors, and it is important that banks start incorporating that into their risks. We also believe, but we believe also this is not our mandate per se, but that there are business opportunities in this, and we think that a number of banks are already well positioned to try and take advantage of these business opportunities. And I would argue that financing the transition, and of course it's not for a supervisor to tell a bank where to invest, but financing the transition is probably one of the important ways where a bank can mitigate the buildup of physical and transition risks in its books and customer portfolios. And so we are very much attuned to the concept of transition planning and so on and so forth. Of course, whatever I'm saying here should not be construed as an outright call for divestment of a number of sectors or geographies. This would be outside our mandate, I believe, but making sure that all of this is duly analyzed and mitigated, which could in turn, depending on net zero objectives and so on that are being taken by banks, which could entail, of course, exiting this and that customer or whatever. But I think for us, the important topic is really making sure that from a risk management perspective, risk appetite perspective, and business strategy perspective, this is fully embedded into banks' journey all over the place. So this is what I could add for the time being.
Thank you, Patrick. And I think maybe to complement on that, I mean, I think at UNEP FI we have traditionally seen the work on risk and the work on alignment as complementary. Separate strands, but complementary. And what I think that the EU regulatory framework also does, quite interestingly, is to connect these dots. I mean, your words right now reflect that transition can help you mitigate risks, but there are broader risks that are impacted by the sustainability factors. So that is quite concrete. And I would like just to follow up, I mean, briefly in terms of if you could share some of the observations from the ECB side as regards to the climate risk disclosures from European banks. What do you have been seeing for now? And what do you think is also going to happen next? Yeah, that would be.
I think we regard disclosures as a very, not only for banks, by the way, but as a very essential component of what I would call a broader data discovery process in that context. We all know that we still struggle a little bit with some data sources and so on and so forth. Additional disclosures are one of the ways to bridge this data issue together with further customer engagement and other initiatives. We strongly believe that data exists only when there is a need. So this is data demand that creates data supply. And so we really look at disclosures in particular from that angle in that respect. Of course, we look also at disclosure from the traditional Pillar 3 angle, so market discipline angle, and those two angles are really at the heart of what we have been doing so far on disclosures. We publish in April this year our third report analyzing the progress on disclosures from European banks, and we are happy to see that we have seen progress. We believe we are not there yet, far from it, but we have seen progress. Most of the banks now provide basic disclosures on materiality assessments and so on and so forth. We have more than half of the banks providing metrics and targets on risk management and business appetite targets and so on. So I think we see progress in that front. Of course, since the beginning of this year, we are now under, of course, the official regime of the Pillar 3 disclosures as per EBA regulation, and we will continue, of course, monitoring progress on disclosures from that angle, starting from the 1st of January 2023.
Thank you. And maybe just briefly to understand also from your side, because in order to comply with some of these disclosures, as you said, there's a data need that drives the disclosures. What do you think are some areas, like in terms of transition financing or maybe, buildings, etc., do you think are going to be moving this forward?
We hear very often from banks that, of course, there is a number of areas. We understand that physical risk assessment is an area where there is a sense of wide diversity in approaches, and sometimes we hear a little bit of a fear, of course, of concern that what banks disclosed in some areas is not necessarily consistent from a methodology perspective, and so that would impair the comparability with other institutions. And there is, of course, I think some elements of truth in this. We would fully encourage the banking industry itself to also start working together with a number of international fora, I mean, they were mentioned earlier, to improve the consistency of methodologies. The danger is that if we wait until we have the perfectly consistent methodology for everything, we will be way beyond our horizon timeline for the objective. So it's better to start now, accepting a little bit of inconsistencies and making sure that we all work together, supervisors, regulators, industry, towards bringing more consistency to the disclosures where needed.
Thank you. Thank you very much. And I think now I will turn to Burçak, saying like regulators, supervisors, industry. I mean, I think we have heard, of course, from the different banks that have already participated in the panels, very clear messages and very clear approaches on the regulatory landscape and what is coming. But I wanted to get more the view from the European Industry Association on what do you see in the landscape of sustainable finance regulation and supervision? What are the key elements impacting the most the membership?
Thank you, and good morning again. Before I start, I would like to say how grateful we are to be here. And for me personally, really great pleasure, because in 2018, I remember quite vividly how we, as the EBF, endorsed the principles for responsible banking. And that was already after several of our banks had been involved. And we're very grateful to see the progress of this great initiative. I want to thank UNEP FI, you, Daniel, and of course Eric and Mustafa and everyone else involved in this event. And may I also acknowledge also our my team member Denisa Vermeite, who is sitting over there next to Tony. And Tony, we're very grateful to have as a chair of our Sustainable Finance Expert Group within the European Banking Federation. I'll come back to what we are doing collectively. And Denisa is our lead with a very small team, actually, delivering a lot on sustainable finance. So the reason why I'm able to claim a role in this big adventure is because of her great work and that of her colleagues. So I want to make 3 quick points about the impact on our business as banks. First, where is the impetus coming from? Second, what role does the Sustainable Finance Framework have within that impetus? And then third, what is the impact on banks as individual actors and also collectively? So first of all, on the impetus, throughout the morning we heard this message. All corporations, and certainly banks, have anyway an intrinsic reason to adopt a sustainable business strategy. It's because society is changing, and any corporation active in the economy that interacts with the rest of the economy, and certainly a bank, the business of which is to serve clients, has to take that into account. So the impetus is really coming from both the outside, the environment in which a bank is doing business, and also, frankly, inside, because the employees are changing, the leaders are changing, and that's a very good thing. So there's a lot of reason why banks need to pay attention to climate and the rest of the sustainability agenda and adopt and align their strategies. Now, in fact, therefore, they have a reason to see sustainability not as a compliance exercise. You've heard this many times. It is really true. If you put it into the center of your strategy, I mean, ideally not somewhere in the periphery, but really in the center, then as a bank, you'll be able to draw a lot of the benefits, take advantage of the opportunities that Marcel was talking about, and hopefully know, manage, and minimize the risks, which are quite real. Now, what role does the Sustainable Finance Framework as such play in that impetus? First of all, any actor adopting a sustainable business strategy, working in a market by definition, where that market is regulated, expects a couple of basic rules from the policymakers in order to be able to advance their own individual agenda. And that's needed for competition, fair competition, clarity of the rules, making sure that you'll be able to make profit out of your business model, because you're going to adjust your business model by definition. And you want essentially some of the basic rules that are needed for this to apply to your competitors as well. So for all these reasons, anyway, any company in any sector needs some sort of an adjustment in their policy environment. But even more so, I would say banks, because of course, as we all know, banks and insurance and all the rest of the financial sector, because our sector is very regulated. So if society is changing, our own strategy is changing, then we also, of course, need our policy environment to keep up and even enhance. And that's essentially what we are seeing with the Sustainable Finance Framework in an environment where shareholders, other stakeholders, clients, employees are paying attention to what a bank is doing. We see this in the Sustainable Finance Framework, which is putting in place rules that actually allow those stakeholders to know what is going on in a bank and in the clients that the bank is financing. So essentially, the Sustainable Finance Framework, I think we can see it as an enhancer of what's happening in the society. On the other hand, it is also a lot to deal with. It's simply a new, series of changes that you need to put into place. So even if you don't see it as a compliance exercise, as a pure compliance exercise, it is true that there's a compliance element, and you have to take it very seriously. And you need to engage with the supervisors. Now, in our case, I will probably come back to that in a second, but the EBF is very happy to work with, for instance, the ECB, Patrick, and Denise, my colleague here again. We've been working on the supervisor expectations and how climate risk is embedded in the way a bank deals with risk. So it's not just a copy-paste exercise, certainly far from it. It's definitely something that changes the way you interact with your supervisors. And finally, yes, it has all this great role of enhancing and enabling what a bank anyway wants to do with societal changes, but it also has its own limits because the Sustainable Finance Framework, by definition, is a framework that essentially deals with the financial sector and corporations that are served by the financial sector, but a lot of other things which we have heard about this morning that need to come from the governments. For instance, we heard about the grid and other strategic decisions about energy, industry policy, all these things, and above all, subsidies, incentives, things that actually really will change the economic activities have to also complement what is happening with the Sustainable Finance Framework. Now, very quickly on the impact on individual banks. I mean, many of you are working for banks, so you know how much has changed over the last 5 years, even 10 years, in some cases for the front runners. I think we have seen that many business lines, even all business lines, are affected in one way or another, especially by climate. Maybe less so for the others. I mean, I personally am very involved in diversity, equity, and inclusion, so I know that, for instance, not all business lines are affected by a D&I agenda, but many are affected in a bank's business, both client-facing and back office. Governance has changed. Daniel, you will remember from the time you were with the EBF, you had initiated this great report on the SDG governance. So we know already, 5-6 years ago, banks were really changing their governance. Some more recent information was cited by Eric, so I won't repeat that. But I do remember from the first report that we did was many banks, especially PRB, were already changing their entire governance structure to deliver the sustainability agenda. Then there's the capacity angle. We know that a lot of banks are already investing time and resources into training their own staff and even training their management. But this has to trickle down, and it's a massive impact that I'm sure we will be dealing with for many years to come. And finally, also in dealings with stakeholders, communication, a lot is changing. Now, if I may just take 1 or 2 more minutes to say that, all these things are happening at the level of individual banks. And of course, individual insurance companies, asset managers, all the rest of the financial sector individually, depending on where they are in their journey, some a little faster, some a little slower, depending on their geographies, business models. A lot is happening at the individual level. And then I would say the sustainable finance framework has also had a massive impact on what the banks are doing, have to do collectively. Why? Because many of the things that they need in terms of this enabling framework are indeed done through the legal framework. So first of all, collectively, they need to look at the proposals, make sure that they are implementable, and where possible, we of course give input to ensure that the regulation is efficient and consistent. So that has meant a lot of regulatory work. I would say quite constructive advocacy. So certainly in our case as an association, there has always been a very consistent line of endorsing what's happening in principles, but trying to improve the implementation. That means a lot of work for the group that is chaired by Tony, for instance, that I was talking about, and a lot of technical work as well. Another big impact that we have seen in our work is that in addition to and as a complement for all the regulatory work we have been engaged in a lot of best practice work. And that's things like, of course, the principles for responsible banking endorsement that we had. For instance, we endorsed also and started rolling out within the sector the principles for women's empowerment principles, which is also a UN framework. The work that we're doing with the ECB on risk, that's essentially best practices, allowing the really engaged banks that are maybe a little bit more advanced in some areas to come together and identify what could really work for the rest of the sector. So this is very important. Another example of that is we work a lot on SMEs and how the SMEs are incorporated in the corporate sustainability reporting framework is very important. That also requires a certain voluntary approach. There we have, for instance, worked with a different sector, which is the SMEs. Yeah. So I'll stop there.
Okay. No, thank you very much. Makes sense. I think that's a very, very clear message. And I think, we've heard also now, from Burçak, the interesting connections that are happening between all of these actors, no? And we heard from both Marcel and Patrick on the role that the industry plays and how all comes together and connects, no? So I wanted now to turn a bit to you to understand how do you see that, and also what would you see the key next steps in the regulatory framework, supervisory framework, that then I would like Marcel and Patrick also to respond in terms of what do you think and how it's seen from the institutions.
I think, so in terms of what has been achieved and what is now ready to be, more or less ready to be implemented, for us the key piece is the Corporate Sustainability Reporting Directive and all the details that go into that. We're very proud of the fact that we have this piece of legislation. I think it really reflects also a very strong consensus in European society about climate and the rest of the sustainability agenda. For instance, the fact that it is double materiality is something that we're very convinced of. I think society and all the stakeholders paying attention to finance and the corporations do want to know both what the corporations are doing, what their impact is on sustainability, and also what the effects of sustainability risks are on their business. So this double materiality, and with all the good work that has gone into the European sustainability reporting system, and the first set that is now ready to be implemented, I think this is the area to watch. Hopefully, we will see the effect intended. Now, certain elements of that are not, fully complete. So certain things have been prioritized, certain things have been left for later. So that's another thing to watch. I mentioned SMEs. So, for instance, unlisted SMEs, and Anna Botin was also referring to that, right? How especially for the European economies, the SME share, and even within the SME share, the micro share is actually quite big. But certainly the unlisted SMEs, which are not really legally expected to do this disclosure, will, however, practically be expected to do a certain kind of disclosure if they're in a value chain and with the larger companies, and or they will be asked to give information by their financiers, banks. So this is an area that we need to look at, and we have, of course, a solution, the voluntary standards that has to be part of the EFRAG framework. We think would work. That's a priority for the future. And of course, the interoperability with the ISSB. And the way it has to work is, if one jurisdiction is really ahead, more detailed, more comprehensive, then of course the other, the global baseline should be considered as already complied with, if you're already complying with European standards. And finally, on the transition finance, I think that's another big area for the near future, I hope. So there, we welcome the European Commission's recommendation at the end of June. We agree that that was a very good approach, because it's also kind of a new tool, a recommendation in this framework, and it's an area that is very difficult but necessary, the transition. So for us, ideally, not only should the basic concepts about transition finance be clarified, which I think to a large extent the Commission's first document does, and so everyone has to be on the same page, but also eventually you need to have a clarity about what the current emitters' transition plans are, how are you going to evaluate them, and what is a credible transition plan. And for that, essentially, you can't get away from the fact that it has to be linked to the sector, and the sector needs to be linked to the geography and that particular jurisdiction's plan. And it all has to be backed by science, of course. So this is a lot of work. In a way, it's not surprising that it hasn't been yet launched. It requires a lot of actors. But in the end, without that, I personally can't see how we can really make a lot of progress on financing the greening.
Okay. No, thank you. I think that also reflects a bit what we discussed before. So, Marcel, would you like to react briefly, for example, on the transition aspects of the regulation?
Happy to. I largely agree with what Burçak has just outlined. From a policy-making perspective, we think that now is the time not to pile up more rules onto what is already quite a big pile of rules, but to take a step back and move from, if you like, words to action, and help the financial industry, but also the real economy, to apply what is there. So our focus will be on helping with transition finance, and here I think I agree. Transition finance, by its nature, has to give a key role to transition plans, because the transition paths are not only sector specific, but they're also company specific, and so one has to be a lot more granular here, and transition plans can help with that. We want to help with making the sustainable finance framework more usable overall, and that's why I said feedback is so so important. We also have to be, and that's a point that Patrick made on data, which I very much agree with. It will take some time to have all the data available and to make all the data available that we need. So we are off for probably a bit bumpier start than one would ideally wish for, but here one has to be realistic and has to and also be pragmatic. And again, here we want to help with guidance. At the same time, the technical work, the analytical work in the Commission and with the ESAs will continue in areas like greenwashing, for example.
Yeah. Thank you. That makes a lot of sense. So now I would like to turn to Patrick before we go for the Q&A with the audience, just to ask a bit as well, because now we have seen, of course, the Pillar 3 ITS on ESG risks. We have seen, the integration as well of the transition plans and CRD, etc. But if you could also speak a bit more about the forward-looking tools that may be also available in terms of the next steps, that would be very interesting.
Yeah, many thanks. Before I answer, I think I just wanted to reinforce again, I think what I believe is a very important aspect of all of this is really the industry coming together to work towards finding some solutions where some are within the reach of the industry. I mean, let me take one example. How many banks send different questionnaires to the same SMEs? Just to give one example. And we know that we have some regional initiatives, for instance, to try and at least get a basic national starting point for a questionnaire to an SME, where at least you would start from the same basis. So just to give one example. So important that this continues. We know that traditionally, of course, banks, individual banks are sometimes a tad cagey with respect to disclosing more operational topics vis-à-vis peers. There is always a competitive edge to this as well. But I would argue that in that particular context, it might make sense to be a little bit more transparent also to peers within the industry to help progress some aspects that are really methodological and of collective interest. To go back to your question, so forward-looking. So we will continue as supervisors, of course, to provide a little bit of push with respect to implementation, trying to find practical solutions with the industry. We really believe on this, and we want to help supporting. You know that we disclosed a number of what we call good practices for after the thematic review and the stress test. We don't dare calling them best practice for the time being. I think we are a little bit too early for a best practice, but at least we see a number of good developments that are probably worth sharing, and we try to seed that a little bit with these publications. So we will continue in that direction. Of course, we will continue having a little bit of a compliance-oriented topic as well. We have said when we issued our operational acts after the thematic review and the stress test last year that we would enforce if need be. You know that we have essentially 3 waves of expectation. One ended at the end of March, the next one is coming at the end of this year, and the last one end 24. So we said we would enforce, and we will. Sorry about that, but I think it's important part of our drive to make sure that everyone gets to where we need to be as as a collective industry and also important for supervisors. We also said that we would eventually come to Pillar 2. We never said when. I think there is a bit of work for this as well. We used that toolbox also for other areas, like, for instance, leverage finance, for cases where we were seeing some banks very much lagging behind a number of expectations, etc. So we might come to that at some point, but we will see that further. But this is still in our thinking. One thing, of course, we will work on transition planning. You know that we would receive as supervisors a kind of mandate on transition plans, and I think it's important we start thinking how we would implement this, and that's an important part of our work going forward. And we also very much support a number of regulatory developments. We have the EPBD, which I think is a very important tool in the residential real estate aspect. First, to try and bring a little bit of convergence into the EPC labeling across Europe. It's a little bit all over the place for the time being, and I think for the industry altogether, it would be good if we could have a bit more convergence about that. We also see a number of very good ideas with respect, for instance, to the mortgage portfolio standards. We regard this as one of the potential avenues where we could really unlock transition financing and also help leveraging whatever public resources are being put on the transition towards more energy efficient buildings and residential real estate buildings in particular. We believe that given the magnitude of the needs, being able to leverage whatever public resources are being put on this is an important component of the whole framework. So I would stop here for the time being.
No, thank you. Thank you very much. And I think now we have around 15 minutes left. I would like to take the chance to offer the opportunity for the audience to ask questions. So, yeah, I see one there, Mustafa. And then there. Okay. We'll go. Yeah.
Yes, thank you for the panel. Question for the ECB on climate stress testing and capital. You conducted a climate stress test last year. Maybe tell us a little bit about the plans on climate stress testing and whether that will be done in the future. And then on capital requirements, you mentioned a Pillar 2 capital add-on as a potential future work. Would you also consider a brown to green transition factor, that meaning a capital incentive to promote transition?
Many thanks. On stress testing, so the first immediate thing we have in front of us is the so-called Fit for 55 stress test. The EBA has been, together with the other European agencies, have been mandated by the Commission to carry out a Fit for 55 stress test. So this is, of course, something we are working together with the ESAs. And so this is the immediate next step, and I suppose that a number of banks will receive in the coming weeks a number of data requests to respond to this mandate from the Commission. Going forward, of course, we need to continue thinking together with the EBA on how we further integrate climate-related topics into the biannual stress test, or whether we leave it aside for the time being and continue running more specific stress tests going forward, at least for the time being. I think it's a matter of how mature the methodologies are at a point in time, and so this is still under discussion. With respect to Pillar 2, I think your point on is extremely valid, and this is one of the topics we are thinking of, and we are asking ourselves internally for the time being is how to embed and consider this transition question into whatever Pillar 2 framework we would put in place for climate. I think the transition element is indeed a very important one. So fully agree with your comment.
Mustafa, gentleman in light grey suit, yeah, and then behind.
Thank you. Question to Patrick. More or less you responded in the previous question. This is about the economic divergence, because in the last comment before the Q&A you spoke about convergence and divergence aspect of it. So we see economic disparities among Eurozone countries, especially it requires you to strike a balance between the need of stronger and the weaker economies. In such a situation, what do you think are critical components to drive climate convergence from this economic disparities and economic divergence that you see as a single supervisory mechanism?
So I think just maybe to answer in two parts to your question, I think the economic disparities are probably less within Europe. They are within Europe, of course, but we have a broader question as well of economic disparities, levels of development, and so on and so forth. And I don't think this is for supervisors to really take a stance on this. I think here I would really relate to the work on transition planning, having in mind that a number of IPCC scenarios look at the International Energy Agency scenarios, etc., do differentiate transition pathways across sectors and geographies. So there is a way to do it. And so this is the way we would tend to look at it, knowing that we are probably not the best place to decide about this, but we believe that there is already out there a number of scenarios, transition pathways that do incorporate those elements. The second topic is that we know that we have economic disparities, etc. We also know that the buildup of both transitional and physical risks ultimately, and just to remind everyone that if we need to remind a little bit about the science, the more we wait, the more painful it will be. We have already started, during the summer in particular, I think a number of you have experienced nice events, and this will only build up. So I think we need to incorporate, of course, we do incorporate these economic disparities in our thinking, etc. But we have to look at risks as well, and those risks sadly are not a normal distribution. They are a S-curve. So that doesn't make things easier to handle.
Well, thank you. I have two questions, actually. One is maybe an opportunity to see promotion of sustainable finance within the retailing sector. I don't think you have discussed this yet. So are you happy from a regulatory perspective with what we have already? And from the bank side, what you can do and what we can do to promote sustainable finance for individual investors. And the second question is about adaptation. We discussed transition finance, but one area that is really lacking investment is adaptation. It's hard to define. It's even maybe more difficult to invest in, but this is a clear need we have. Thank you.
And can we know where the question is coming from?
Pardon?
Where the question is coming from? Like
my name is Marcel. I'm the founder and managing director of Sustain.
Okay, thank you. So, would you like to take it? Yeah, please.
It won't be exhaustive, but what the question brings to my mind is so the capital markets angle, for instance, of this. When you say retail, I assume you mean retail clients, of course, as as depositors of banks and as borrowers from banks. So we're talking about, and of course, I guess private wealth as well, but especially the small ticket participation from the whole broad swaths of society. So that's very important, and they can come into the picture either through banking or through capital markets. And if you think about it, the entire sustainable finance framework was, in fact, really designed with capital markets in mind. It's just that we in Europe don't have very deep and very integrated capital markets yet. We are working on it. It just so happens that it's something that the EBF has been engaged in for a long time. So I would say to get more out of the sustainable finance framework that we have in place, we should do in the very near future what we can to develop the capital markets and to bring in more retail investors into the market. And that depends on, to some extent, especially the member states. I would say national governments can do a lot. For instance, if you look at the Nordic, well, in fact, the speaker is from the Nordic region, right? Did I hear Sweden? So, I mean, if you look at the Nordic region, and if you look at some other countries, you have a lot of retail investors engaged in the market. So whatever has worked in other jurisdictions in terms of incentivizing, simplifying, streamlining the procedures through which retail investors come into the market would be great as a best practice to spread across Europe. And a complementary action would be to not only to develop capital markets across Europe, but also to add to that the bridge between capital markets and banking, and that is securitization. So the green securitization, for instance, has a very big role to play as well. That's hopefully for the next legislative cycle. But broadly, retail investors can already come into as clients, as depositors can already benefit from the framework, but they will be able to do that even more if we have deeper capital markets, would be my view.
Thank you. Okay, I think we have 4 minutes left, so if there's a very quick question, we can take it. If not, we go to the conclusions. So, yeah, Mustafa, thank you.
Thank you. My name is Andrew Funk from Homeless Entrepreneur Foundation, and my question is related to the increase of homelessness in Europe. It was reported that approximately 895,000 people are homeless. It keeps increasing, and I'd like to know how that's being addressed when you deal with sustainable finance and how they're included in the design to reduce it. So my question is, how can sustainable finance reduce homelessness in Europe? Thank you.
Who wants to take it? Burçak. Okay, maybe I can briefly just say that I think the social aspect of sustainability is being integrated and is being developed, and I think we have seen some elements coming up in the regulation, and to some extent also some financial institutions will look into it, but I don't know if you want to comment on that.
Yeah, I'm not sure that that there is an exhaustive and comprehensive answer to this. The EU Sustainable Finance Agenda covers E, S, and G. So that's to be clear about that. Now, in developing this framework, the top priority has been given to E. So the framework that has now been put in place is very granular and very much developed on climate and other environmental challenges. The environmental, the social dimension and the governance dimension is not completely disregarded, which you can see in the fact that the taxonomy requires that social and governance standards have to be complied with, but there is not an equivalent of the taxonomy yet in place. Clearly, there is an appetite for having guidance on social investment, and that's true for both sides of the market. Investors and investees take an interest in that, and the Commission will report on what can be done in that area, but that still has to be done.
Thank you. Okay.
Very briefly, adding, I see two elements. I mean, first of all, the basic financial inclusion policies of individual banks, of course, does take into account, in some cases, also homelessness. So there's a certain approach from individual banks about who can open an account and how, and as part of the challenges that they take into account, there's the homelessness aspect. But looking broader at the framework we have now, there are already sustainable bonds, social bonds. There are certain tools that are out there that correspond to this equation that Marcel is talking about on the supply side, I guess, in this case of finance. So there are investors who are willing to put in their money into projects that do not have the same kind of financial performance that finance was used to having, 10 years ago, 20 years ago. Today, fortunately, we're in a different reality. All these investors who are interested in social entrepreneurship initiatives with different kinds of benefits that they want to draw from the project have a bigger array of tools, platforms, also, by the way, crowdfunding platforms. So both really private funding mechanisms and also more public markets. So I would hope to see more of them. And hopefully, we will have the bigger changes in the economy that will hopefully bring down homelessness. But to the extent it continues to stay, there will be more tools.
Thank you. So I wanted just to say now, if we have like a few seconds for everyone to conclude, just a few words that you would like the audience maybe to remember or to take with them. So starting with Patrick now in this case.
Don't hesitate to, especially if you're a bank, to engage with your peers and with us as early as possible. I think we have a lot of things to sort out together, and it's better to engage as soon and quickly as possible.
Banks are part of society and they're financing society, so they want to adopt sustainable business strategies that work, and hopefully together with the policymakers in Europe in particular, will make it happen.
I could not have said it better than Patrick. Engage, provide feedback, help us to make sure that things work as they should.
Okay. Thank you very much. So now we go to the. Oh yeah, please. Sorry.